Hey, this is Mark from Caliber Home Loans, and it is Friday the 24th. We're going to go through the market, what went on the past week, and then what we expect to see for next week. So overall, again, before we get into the graphs and the charts, once again, regardless of what's going on in the economy and with jobs and everything else, the Fed just keeps buying bonds. So this has really kept rates fairly consistent. So let's go ahead and dive into the market. So this is today's chart. So I'm using a different charting system just because this one's a little bit easier to read for a one-day look. So this is where it opens up, where the market opened this morning, and this is where it ended. So it closed just a little bit, a hair above where it opened. You see during the course of the day, prices did go up a little bit, which pushes rates down, but it really didn't affect rates at all. So there was really very little movement during the course of the day. So let's go ahead and look at the past week. So you can see that we started here and about 104.4, and we ended up 104.5. So even though it looks like there was a big increase in price, the price was very minimal. So again, Tuesday, Wednesday, and Thursday, pricing went up. Rates pushed rates down a little bit, but at the end of the day, towards the end of Thursday and today, the pricing got a little bit worse, and so rates ended up pretty much where they started the week. So it just depends on where you're looking. So if you're looking from Wednesday, yeah, rates got a little bit worse than from Wednesday, but based on where they started during the week, they're about where they were. And so over the past month, again, there isn't a whole lot of movement. We had some dips based on what was going on in the economy, but all in all, rates have been just very consistent. It's with the Fed dumping money, the amount of money they're dumping into the markets every day, it just keeps rates at a very consistent level. Yeah, they're going to go up maybe an eighth here, down an eighth there. We did come off our lows. I mean, I know last week all the media was saying that we've hit our all-time lows. We did come off of that, so we're not at the absolute low anymore. But, it's just a timing issue. So we don't expect rates to jump up anytime soon. We don't expect a whole lot to change in the economy. The money flowing in and out of the stock market is really not having a whole lot of effect on the bond markets where it normally would. Again, it's because the Fed is buying they're the major buyer, one of the only buyers in the bond market. So that's why rates have been so consistent. So let's take a look at what's on tap for next week. So on Monday we have durable goods, not a big deal. Consumer confidence, this can be a mover, but again, with the amount of money that the Fed is pushing into the bond market, I don't expect it to have much of an effect. So Wednesday is the Fed adjourns their two-day meeting. So normally this is a really big deal because they can always surprise us, but nobody really expects the Fed to do much of anything. There's no expectation that they're going to raise rates anytime soon. Most people are still thinking 2022 before they start raising rates. It really just depends on, a lot of it's going to depend on the pandemic and availability of vaccine or rapid cures, that kind of thing. But based on where we're at now, nobody expects them to do much of anything, at least till the end of 2021. Weekly jobless claims, this is always a big deal. I think we're looking at another about 1.36 million in jobless claims. So again, typically in a normal situation, if jobless claims were expected at 1.36 and it came in lower, then that would be good for the economy. That would push rates up. If it came in higher, that would be bad for the economy, push rates down. But again, this isn't a normal situation. GDP, second quarter GDP, this is a big deal. This is an important number. We do expect it to be down 3.5%. That's the expectation. So again, if it's down less than that, rates could go up. If it's down more than that, rates could go down. But you're not going to see a big movement in either direction because, once again, the Fed's in there plowing millions and millions of dollars a day into the bond market. Friday we have the core inflation. We don't expect a lot of surprises, and this isn't the consumer goods. This is the core, and so the expectation is up 0.2. I don't know that that's going to happen. It could be a little bit higher. It could surprise us it could surprise on the upside a little bit, but we'll have to see how that pans out. And then the second quarter employment cost index, not a big deal. I mean, everything can be a big deal, but as long as it's fairly in line with expectations, it's not going to move much around. And then the U of M consumer sentiment. So again, this is one of those numbers that, in a normal environment, if the consumers are really having a hard time and the number comes in lower than expected, this would typically push rates down. But again, it's with all the movement that's going on in the stock market, it just isn't having a whole lot of effect on the bond market. They're kind of disjointed right now. So, and again, I keep coming back to this. The amount of money the Fed's plowing into the market has really kept the pricing consistent, fairly consistent, and the rates fairly consistent. So that's what we're looking at, for the market and for what's going to go on next week. So, rates are super low, and anybody who thinks they can time this and is waiting for rates to go lower, I'd like to borrow their crystal ball for an hour. So, and I've said it before and I'll say it again. MSHA is about a week and a half behind in picking up loans for underwriting. So if you've got a MSHA loan out there, you're writing a MSHA offer, give yourself some added time. I would go out at least 45 days. You may not need that, but if MSHA continues to get backed up by the time that loan gets to MSHA, they could be a full 2 weeks behind or more. So give yourself a little bit of extra time with the MSHA loans on the end of the down payment assistance loans. Other than that, we're coming back with, Caliber's coming back with some of our jumbo products. We're pretty excited about that. We are at 20% down on the jumbo right now. That'll start to ease up, I think, as we move through some of the unknowns with the market and forbearance. Forbearances are down, so that's a good thing. And then I included a video in this week's email about forbearances versus foreclosures. Anybody who thinks there's going to be mass foreclosures, I think that you're wrong. I think this is not 2008, and the number that keeps coming at me is that 77% of those that are in forbearance that are actually behind in their payment are sitting on 20% equity or more. So I keep coming back to the same question. If I'm sitting on 20% equity, why would I foreclose, hand my house to the bank, and walk away with no check and my credit ruined? So watch the video. It's got some statistics in there. If you have any questions, need pre-approvals, give me a shout, 248-705-8431. Have a great day.